Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, August 16th, 2022. Welcome back to the podcast, George.
Great to be back as always, John.
Yeah, good to have you. So plenty to talk about today, just like pretty much every day of 2022. But more specifically, data releases have clearly spun the markets for a loop a few different times this month. What comes to mind, obviously, is the blockbuster non-farm payroll report and the relatively tame CPI inflation report, emphasis on relatively there. But said another way, bond markets have seen a healthy level of volatility as of late. Kind of as I alluded to earlier, in many ways, it's sort of par for the course for 2022. But given the proximity of both those data points, price action has felt pretty extreme in the rates market, while in contrast, stocks and credit just seem to trade higher on good news or bad news. So you and I have talked about this offline, but one interpretation of price action is that price action specifically in risk assets is that the market expects the Fed to pivot given peak inflation is behind us. So I guess the question for you, George, is what do you think about that thesis? Is the Fed actually about to pivot, as some markets are suggesting?
Yeah, that's a great point. And I think those are something we're going to be wrestling with as we get through the end of the summer and you look forward to the September meeting and everyone really getting back in their seats and digesting risks for the end of the year. I think that we really have to define what is a pivot to begin with. If it means that they're going to be changing policy towards easing, that's definitely not going to happen. I mean, we still have very high inflation, and even though we've seen potentially the peak of inflation, at least when it comes to the energy-related influence on inflation, and again, this is still to be determined. I think it's still too early to say that we've won the war on inflation. Maybe we've had at least one battle under our belt, but the moves in energy could very well resurface if something were to change. And so I'm not really placing too much emphasis on just one number, but let's just assume that we've had the peak of inflation. It doesn't necessarily mean it's going to necessarily collapse and go down towards the Fed's target of 2%. And I think that's really the struggle that the markets are having. They're viewing that, well, if the Fed just stops, or if the Fed stops being as hawkish and starts to become less hawkish, is what I should say, then that is, a cause for to kind of get optimistic on the outlook for both markets and the economy. I think that's a little bit premature. The core inflation has remained still relatively high, even though it also came in a little bit weaker last week. But sticky inflation and services-based inflation is also still trending higher and broadening out. And that sort of sticky inflation does not just go away even if headline were to come back down further. So I think the Fed's going to be really, we mentioned this a few times before in the podcast as well. We're going to be seeing the shift clearly away from headline to focusing on the core. And as long as core is staying north of 4%, 3.5%, and it doesn't look like it's heading lower, then it's too early to say that the Fed is about to pivot. And I think that means that we probably have at least a few more meetings into year end, beyond the midterm elections, and really focusing into the early part of 23 to see if this weakness now on the growth side really starts to set in. By then, maybe the Fed can pivot and start to at least pause. But I think the distinction here should be that just because they're going to stop hiking at some point, and I think they still have at least 100 basis points to go, once they get there, they don't have to necessarily start cutting rates. That's the other side of the equation. The market has been pricing this kind of kink in an inverted yield curve in the money market strip. It has influenced long-term rates as well. We've had a deep inversion. If the Fed wants to get rates north of 3%, that should happen, I think, in the upcoming meetings. Then the whole term structure should head higher too on the cash treasuries. And then maybe some of these inversions will start to get ironed out. And then the Fed goes on pause. I mean, of course, they can ease anytime they want, but I don't think they're going to be as quick to ease this time. And perhaps the eases get pushed back unless there's really a sharp slowdown, and at the same time some major correction in risk markets. But we're not seeing that. So as long as that we're seeing the economy and job market still relatively robust and risk assets doing well, the Fed has to keep leaning harder into it. And I think that we cannot claim that this is a pivot, and we'll get more signals of what a pivot would look like, perhaps in the next 2 or 3 meetings. But I think that the market's been really suffering from wishful thinking.
Yeah, totally. And you could argue that financial conditions have gotten even easier as of late, which means the Fed will have to do more, whether that's hike rates higher, reduce the balance sheet more, or stay on hold at a higher level of rates than they otherwise would be. Um, but moving on, this really all fits pretty nicely with your most recent macro to market strategy report entitled "Markets Want a Fed Pivot. They May Get a Fed Pause Instead." Why don't you take our listeners through the high points of that report?
Absolutely. So the bottom line for us is, we're shifting our Fed call a little bit, where we think they're going to be on hold for longer at a higher level of rates, which is something we have not felt, or the markets have not, and the economy has not had to deal with for quite some time, for over a decade and a half. In the last hiking cycle, the Fed got to 2.5% and quickly pivoted. And I think that's part of the reason why, it's kind of conditioned a lot of traders and investors to think that once there's a sign of trouble, the Fed's going to easily fold and go the other way and start easing, because that's what they did in 2018 into 2019. But this time, because inflation is a binding constraint, like we've been saying, um, they have less flexibility to do something like that. So, if they end up staying on hold for longer as they ensure that inflation truly is making a run toward their target of 2%, that could be a long wait, and it could take a number of quarters until they have conviction that they're on the right path and that inflation won't just resurface later on. So, a higher rate profile is not what markets are pricing to right now. This is all markets, not just the rates markets. Everyone's expecting Fed will eventually fold, ease, and maybe even stop QT, and then maybe even bring back QE. And it's this kind of allure of easy money and liquidity, which I think is also kind of masking and influencing valuations and markets sentiment overall. If the Fed disproves that by getting rates to well beyond 3, closer to 4 perhaps, and they stay on hold for a number of months and quarters, we haven't felt that again for many years. And the rollover risk for markets and for products that are floating rate based are going to really start to take a harder hit there, which then might eventually end up with a recession later on. But you're going to need to have that burden of the high rates first in order to really see if it's working its way against inflation, if it's coming down both through natural reasons as well as the Fed's actions, and then this really tightening of credit, which the Fed is really embarking upon through the rates channel. But also very important, which you mentioned too, is that coming in September, when we hopefully we'll reconnect, is the QT will get to the full maximum speed. I call it max QT. Once we get up to that close to the 90 plus billion per month, 95 depending on mortgage prepays, but nonetheless we're talking about 80 plus or so prepays and plus treasury roll-offs, which will be a big drag on fixed income markets to underwrite on a ongoing month in month out basis. Plus, there's the potential for more issuance coming from the corporate sector, which has been starved from issuance because of a really tough first half of the year. The perfect storm of supply deluge could be upon us in September and early October, which could result in a pretty big rise in rates, widening of spreads, and a steepening out of the curve, and really challenging a lot of the positions that were put on as part of this flattening thesis. So I think that's the risk in the next 6 weeks once we get past the Jackson Hole and into the start of post Labor Day and into the start of really the second term of our year. I think that's what lies ahead, and that's a lot of the points that are covered in the piece. That financial conditions have eased. The Fed has to lean against it. Inflation is sticky. They're not in a position to pivot yet, but the markets have kind of jumped ahead of themselves a little bit here, and a combination of these more technical supply factors and QT could be a rude awakening as we start the September trading sessions.
Wow, sounds like an eventful September, and hard to summarize all the good stuff you got there, but clearly very big differences between what the Fed was doing in 2018 and 2019 in cutting rates quickly, because inflation was not a binding constraint then. Potentially 80 billion plus a QT plus IG issuance in September, challenges to the flattening thesis. Sounds like it sounds like it's a good time to get some vacation and rest and relaxed for September. And for our listeners, I would definitely encourage you to check out George's most recent macro to market strategy report, again entitled Markets Want a Fed Pivot. They may get a Fed pause instead. And again, if you're not receiving George's stuff directly, please get in contact with them. Excellent stuff as always, George. Thanks again for coming on the podcast.
Thanks, John. Thanks for having me.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.